Welcome to a special episode of Checks and Balances TV. I'm Mickey O'Neill sitting in for Matt Reddick, and today in studio we have a special guest, Randy Packett, a financial advisor from Baltimore, Maryland. And today we're going to talk about a variety of subjects, beginning with one that's a real sore subject for a lot of Americans, and that's the inheritance tax, the estate tax, the death tax. Nobody likes it. Everybody saves and scrimps their entire lives, and then when you're gone, Uncle Sam shows up with his hand out. Randy, talk to us about the inheritance tax.
Well, Mickey, thanks for allowing me to come and speak with you today. One thing nice about the inheritance tax or the estate tax is finally the government has done something good about that recently. They actually have moved the threshold of how much you would take in order to pay the estate taxes to the $5.25 million in 2013. So if you're a single person and have an assets under $5.25 million, then you don't have any taxes to worry about at a federal level.
And that's nationwide. Is that permanent?
It's permanently fixed now, and hopefully they don't change that in the future. And if you're married, husband and wife, we'll double the number to a little over $10,500,000. But each individual state also has what they call an inheritance tax, and every state will have their own threshold. In the state of Maryland that I'm from, unfortunately, that they have kept the number below the $1 million level.
Well, with all these taxes that take effect after I'm gone, I've spent my entire life protecting all of my investments and my properties and so on, but once I'm gone, I can't do anything. So how can I protect my heirs? How can I keep them whole? Well,
one thing is, I think that's the easy target for the federal government to go after is someone who's already dead. They can come back and fight for it. Therefore, that they have to raise the number to $10.5 million for a husband and wife and $5.25 for the individuals. Once that you're gone, you have to deal with your total assets. And total assets meaning adding up your cash, your properties, all the assets that you have to add numbers to see what the numbers will come out in the end results. Once the numbers gather and you know what it is, and the numbers below the $5.25 million, then you don't have anything to worry about.
But that's how some people get caught by surprise, too. They undervalue their home, or they forget about that little piece of property Uncle Joe left them up in the mountains that is now a hot target for real estate investors, and Uncle Sam comes in and values it at some extraordinary number.
That's true. I think another area of concern is most people, either they don't understand or they're misled that they don't have to add their life insurance death benefit as an estate tax number.
That was one of my questions about hiding money in life insurance, so that's a no-no.
No, it's a great way of enhancing your legacy. However, you have to understand that life insurance death benefit is an income tax-free, but it is added in as your estate tax. So if you have $5 million worth of total estate numbers, and then you have another $5 million of death benefit, now your total assets the government will use will be over $10 million under the estate tax purposes.
I see. So with all of that in mind, how do I protect my heirs?
Well, there are many ways of doing it. One easiest way to give the money out to your loved ones will be gifting. Government allows you to gift out each year. Last year's number was $13,500 per person. So in my case, my wife and I, we have 4 daughters, so we were able to give out $27,000, which will be indexed up in 2013. So in total of $108,000 of our assets can be gift out to our kids without that number adding into our future estate tax purposes. So if my wife and I live for 20 years, $108,000 times 20 years mean over $2 million can be taken out of our estate so that we don't have to pay taxes at a federal level.
Exactly, and that doesn't impact you in the current tax year, and it doesn't impact the recipient.
No, not at all. One thing is, a lot of people think that by gifting out any type of money, and remember, $13,500 last year is the maximum you're allowed to gift out without filing for gift tax returns. You could give out less than that if you want to. However, that's not a tax deductible number for the ones who's giving the money. Matter of fact, if you decide to give out more than the $13,500, then anything above that threshold, you have to file for the gift tax return and also pay taxes on it as a donor. Person who's receiving the money doesn't have to pay taxes at all on that.
Well, that's a pretty good deal for the recipient. I've heard of another method of, I don't know if it's really hiding money or just good estate planning, and that's setting up some sort of a corporation that the family can all be involved in.
Well, a lot of times the families may create a family limited partnerships or limited liability companies to set up an entity so that they could gift out the money. Right now, I have a situation where the area that I live in, we're very rural, and we have a farm areas where people have, 20, 30, 100 acres. And yet their cash flow is very small. I don't know if you deal with a lot of farmers, but most farmers do not have a lot of money.
They're land poor.
They're land poor. Here's a recent situation that we dealt with one of our clients. This client had 115 acres right outside of a main city that I work in, a place called Bel Air, Maryland. And the place has actually recently been assessed only at $700,000. That includes their home, 115 acres. However, that if something happens to that person and the money has to be reassessed or the land, I have a feeling that place will be reassessed in well over $2 to $3 million. The reason being, he's sitting right outside of the city limit.
Sure.
So you know what happens.
The city grows, the land value goes up.
That's absolutely right. So one of the ways that you could do that is we have asked our client, the farmer, to assess the land as they have been assessed recently with some national company to come out to figure out the real value of the place. Let's say they come out and assess the place at $700,000 as it's been done recently.
Yes.
All they have to do is, if they want to pass that land along to their family members, is we created a family limited partnership, parents becoming the general partners, and then kids will become the limited partners. Now, we have equated the $700,000 into shares of how much shares that they could gift out. So you could give out $13,500 per year per kid. So let's say the situation is like myself. If I have owned that, my wife and I could gift out 27,000 shares each year to the kids, which means 108,000 shares per year. Well, if it's worth a little over $700,000, it would only take 7 years to gift out all the shares to our kids. So if we die after the 7th year, then the whole value of the house and the land will be gifted out to our kids, and it will not be taxed at a federal level or the state inheritance tax level at all.
But what happens if one of the kids gets kind of a wild hair and says, hey, I own 1/4 of this property, you guys are out?
Well, once we're done, we don't really care what happens. However,
what if you're still there?
Well, remember, we're the general partners, and the kids are the limited partners. So we make all the decisions.
Ah, I see. Well, that's a good plan. So gifting is one way to offload, if you will, value from your estate so that it's not taxed later. Perhaps setting up a limited family partnership is another way. What about some tax-protected types of accounts?
Well, a lot of times, if the asset's in a cash form, one of the best way of deferring the money is creating some type of qualified plan, and whether it be in the stock market or having your money tied up in the insurance products, any of those products can be set up as a qualified plan, which means they would have a tax deduction going in. And then when they take the money out, any money that has grown, and plus the principal they have put away, since they never have paid taxes on it, any withdrawals will be taxed at that time.
Just like an IRA.
It's a glorified IRA. It allows you to put away more than the IRA amount. And last year, if you're age 50 or below, anybody could put away up to $5,000 and were able to take the tax deduction on it. And if you were over age of 50, then you were allowed to put away $6,000. Now in 2013, that number has moved up by $500. So under the age of 50, person could put away $5,500. Anybody who's 50 plus could put away $6,500 into an individual IRA.
Perfect. Well, thanks, Randy. I now have a little more of a handle on how to keep my money safe for my heirs and how to protect them. If people want a little bit more information on this, how can they contact you, Randy?
Well, obviously, you could take a look at the screen right below our screen. Should have our phone number listed there, or our website. Our phone number is 866-382-0027, or you could call us or look at our website, cfsiadvisors.com.
Very good. Thank you, Randy. Mickey O'Neill for Checks and Balances TV. We'll see you next time.